Hello, hi everyone. This is Emily, a digital transformation consultant at Hyperbots Systems. Good morning, good evening, good afternoon, dependent on where you are, for today's session on risk mitigation framework for AI adoption in finance. I'm really glad to have Cecy on the call with me, who is an experienced CFO. So thank you so much, Cecy, for being a part of this discussion. But before we dive into it, can you please introduce yourself?
Sure. My name's Cecy Graf. I am based in Seattle, Washington, and my experience has been in the law firm management for almost the last 20 years.
Mhm. Got it. Thank you so much for your introduction, Stacey. So, for today's session, I've essentially divided it into three portions. So, the initial section involves examining the various risks linked to the adoption of AI along with strategies for mitigating these risks. In the second part, we'd cover in depth the risk mitigation framework. And in the third segment, we'll delve into all the financial and accounting sub processes to determine which one yields the highest return on investment and least associated risks, so thereby distinguishes between the most lucrative versus the less profitable ones. So to kick things off, Stacey, as you might be aware, AI has started seeing real adoption in finance and accounting, and it is likely to accelerate. So what risks do you see with AI adoption?
So I think the biggest concern that we have, particularly in the legal industry, is around compliance and legal concerns. So making sure that the information that is being provided actually adheres to all of the things that we need to adhere to. There's more, but that's the ones that I think are the biggest concerns for us right now and the things that are a real barrier to adoption.
Got it. So compliance and legal concerns. Okay, so let's go deeper into this particular risk. Can you please, elaborate on promised AI benefits versus the real returns?
So it's really exciting, right? I mean, AI has the potential to completely revolutionize how we do things in the ways that computers did and had such a huge impact on how we process financial transactions and provide the information that is gleaned from those transactions. But it's a classic garbage in, garbage out challenge. So
Mhm.
you only get a high quality output if you're putting in high quality inputs. So we have to be, and this is, of course, not specific to AI. We have this problem with any of our information delivery, that we have to be capturing good information. We have to be providing the right data points so that we can get the best outcome out of our AI tools.
Yeah, that's correct. So, what would your recommendation be in order to really mitigate this particular risk?
Data governance. We've really, I mean, and this, again, this isn't new. It just makes it so much more important if we're going to be automating and applying artificial intelligence to our data, that our data is crisp and clean and as perfect as possible. So really having good data governance strategies in place so that you can really leverage the power of AI.
Got it. Understood. So moving on to the next one, Stacey, in terms of security, do you see security as a concern, and what exactly is the risk there?
So in the legal industry, we of course have very strict client confidentiality rules and obligations. So having any threat to our data in terms of leakage or having the data be used inappropriately when it comes to how we service those clients and how we care for their data is a huge concern for us. And one of the things that is, cybersecurity in general is a major focus for the industry because we are, like every other industry, under threat. But we have to be the risk of AI and the things that concern people around how AI is implemented within the legal industry really come back to how are we making sure that we are fulfilling our client confidentiality obligations. So how do we protect against leakages? How do we protect against data breaches?
And do you have any recommendations, AC, on the way out to alleviate this particular security related risks?
Well, again, this isn't new to AI, but having very strong data protection measures in place and making sure that your certifications, if you're getting ISO certified or SOC 2 certified, that you've got those certifications and all of the rigor that is required to get those certifications in place to protect your data. Um, the the challenge that we face right now is with OpenAI or with open tools is that people don't realize the openness of those open tools. So we have to make sure that we have very strong effective use or appropriate use policies in place and that everyone in the environment is familiar with those and understands the risks associated with them. But this isn't, again, not specific to AI. These are data protection things that we should have in place and that we should mature for our safety regardless.
True, completely agree on that. So, CC, the perception of AI leading to loss of jobs right now is real. So, what are your comments on that?
So I think there's going to be a shift in the jobs, not necessarily a loss of jobs. We had the same concerns, showing my age a little bit, but we had the same concerns when we started implementing computers in the workplace, right? People thought they were going to lose their jobs because of that. And that's not what happened. The jobs changed, how you perform the duties changed, but the jobs didn't disappear. We didn't see greater joblessness because of computers. In fact, we saw more. And we're seeing that just in legal practice as well. Like there's this threat that AI will replace lawyers. And the fact is right now AI is creating more work for lawyers as we navigate and figure out what the structure needs to be around these. So I'm not as concerned about the loss of jobs. I think it makes it really important for us to think about what those jobs of the future are and how we position ourselves to take advantage of that.
Got it, got it. And any recommendation on how can we actually change this perception in people?
I think it has to be about investing in our people. So not that this is a scary AI tool that's gonna take away your job. It's a exciting, innovative tool that can change how you perform and allow you to provide higher and better use. So everyone should be ideally working at their highest and best use. And AI can take away a lot of the grunt work that people spend a lot of time on and really free them up to upskill and to be able to expand their horizons rather than being this threat to our environment.
Mhm. Yeah, true. So along the same line, Stacey, there's also this fear that AI can start dictating how humans should function in their roles and to what level. So from finance and accounting context, do you see that as a real challenge?
Um, I don't see as much. A lot of it, again, is how you have your effective use policies in place and how you are utilizing those tools and how you've trained your people to use those tools. I don't see it as AI dictating how people do what they do. It is more AI informing how people do what they do so that they're getting better data to drive data-driven decisions instead of just following your gut. But I think having that ability to follow your gut, even when you have all of the data, is still critical. So we're not robots. I don't expect people to become just AI directed tools. It's more how are the people going to direct the AI tools?
Correct, correct. Completely agree on that. So, however minuscule that challenge is, Stacey, what is your suggestion to overcome this?
It's all about culture. It's all about training your people and making sure that your team feels invested in and engaged in the process. If they are part of the solution, then you won't have as much resistance to how you apply it. And it is really creating that security within your environment that this isn't a threat, this is an opportunity.
Mhm. Got it. Got it. So, revisiting one of the topics we just discussed, the risk of AI output being trustworthy, especially in finance, is one of the biggest risks, perhaps. So, can you share some examples where this is a risk?
Yes, and this is a really good segue from the whether we're AI driven or whether we drive AI,
Mhm.
because you need the people that are familiar with what is happening and how everything should work to be able to apply that rationalization to the outputs that we're getting from any AI tools. Because there's things, my biggest fear is, of course, you're getting inaccurate forecasts, which of course we get today. Like there's human error today. But if we are completely dependent on the AI and we're not applying any of our own knowledge and expertise to the outputs, then we can end up managing to a forecast that is completely off the rails. And that doesn't position us to succeed. And then, of course, I've got to come back to the compliance reporting, right? If we are completely dependent on AI for our compliance information and our compliance reporting, and we're not applying any other checks and balances to that, then we have a real risk of being out of compliance or reporting it accurately that we just can't do.
Mm-hmm. Got it. Yeah, yeah, that's true. Can you suggest some methods using which this risk can be reduced?
Sure. I mean, I'm back to data quality, right? I'm back to data governance and making sure that you have high quality inputs. But you also need that testing and validation. You need the checks and balances in place the same way we have with people right now. You have to have controls in place around your processes. You have controls in place around your approvals. And that doesn't go away just because we've got new tools in the environment. So we've got to make sure that we've got that testing and validation in place. And the human oversight is a really important part of that. And then, of course, being as transparent as possible. Like, I think that the scariest part of AI is that people don't understand it and they don't really have any visibility into how it's going to be used and what the impact is going to be on them. So being as transparent as possible with your team and involving them in everything to make sure that everybody is on board.
Got it. All right. Thank you so much, Cecy, for talking to us about the various risks associated to the adoption of AI, along with the different strategies for mitigating these risks. Thank you for walking us through the entirety of it. It was great speaking to you today.
Thank you.
All right. Thank you so much, Cecy, for talking to us about the various risks associated to the adoption of AI, along with the strategies to mitigate these. It was really insightful talking to you today. So thank you.
Thank you, Emily. Thanks for having me.
Thank you. Welcome back, Cecy. In the last segment, we covered the various risks linked to the adoption of AI. In this segment, we'll dive deeper into the risk mitigation framework in the holistic overview essentially. So there are two broad views on AI's impact and compliance, right? One view is that AI helps to improve auditability, visibility, transparency, and database decisions in general, resulting in better compliance. While the counter view is that one should take special measures to ensure compliance on tasks, especially where AI is associated. So, what are your views on it?
Well, I think both things are true. I think AI has tremendous potential to significantly improve our compliance efforts. We can automate things, we can enhance our processes, and we can really improve the quality of data, assuming that we have good data going in. But you never get away from having that oversight. We need a balanced approach that recognizes the potential while still, working through the challenges and risks associated with it. So I think it's really important that we absolutely find the best way to leverage AI, but we have to adopt a proactive and balanced approach.
Got it. Got it. And overall, Stacey, if you have to draw a risk mitigation framework for AI adoption, what critical components do you see in that you would advise to your fellow CFOs?
Well, I mean, as a CFO, it's always about the return on investment. So making sure that you're quantifying that ROI and really evaluating the risk associated with it is critical to making any decision, not just about AI, but especially about AI.
Got it. Got it. And one second. Um,
Is that it for this whole section?
yeah, that's what I'm thinking. It's just 2 minutes.
Is this the same as it was for others?
I mean, for this section, I thought you were going to talk about people change management and that entire portion. So I thought it's going to be longer, which is why maybe I
Oh,
put two of those in this one.
okay. I don't have enough notes for that.
That's okay. We can do it the next time, the second section of it. And today we
Okay.
can just move to the third section. Would that be okay?
Oh, sure, sure.
Okay. All right. So now I'll say welcome back to the last segment.
Okay.
Okay. So weird. Okay. Fine. Welcome back to the last section or segment of this discussion, Cecy. Thanks for taking us through the risks instilled in AI and its mitigation. Now we'll talk about the different sub-processes in finance and accounting, the associated ROI, and the risk to answer which solution should be the optimal first pick basis the different parameters. So I wanted to understand from your point of view that out of all the finance and accounting processes like FP&A, AP, AR, procurement, expense, taxes, even treasury, in priority order from risk management perspective, what would be your stack rank in increasing order of AI associated risks?
So my stack ranking really starts with expense management. It's pretty straightforward. It is relatively easy to automate. You should have standardized processes in place. That makes it a lot less susceptible to the risks. And a number of companies have already kind of worked through their expense management, which sets it up nicely to have AI take the reins when it comes to that sort of thing. And the risk associated with expense management is relatively low. Your inaccuracies are more around coding things to the wrong accounts and less about getting the wrong numbers overall.
Mhm.
Hand in hand with that, next comes really accounts payable processing. So automation and AI can really streamline the invoice processing and payments. And we just have to make sure that we have the right fraud detection in place, which usually happens with the bank anyway. So your risk is mitigated there already in a number of ways. You just got to make sure that your processes are processing things accurately.
Mhm.
Next on my list is really accounts receivable, similar to AP, but with more emphasis on prediction rather than reporting. The prediction inaccuracies could affect your cash flow forecasts and that sort of thing. So you really have to, again, make sure that you've got that oversight in place to make sure that what is being predicted is reasonable. And really incorporating your knowledge of where your customers are that AI may not be fully informed about. But that I think has a real opportunity to kind of streamline and free up resources to spend more time on those customer relationships, particularly with outstanding balances, rather than the analysis part of that.
Mhm.
So next on my list, are we ready for more? is is procurement. So procurement involves more complex decision making. So there's a little bit more risk and more effort put into training your AI with vendor selection and contract negotiations. And your risks include some bias, again, depending on the data that you're putting in there around your around what is important and how to select your vendors. And then when it comes to negotiating terms, obviously I'm in the legal industry, so I'm a big fan of lawyers, making sure that you have lawyer oversight when you're negotiating those terms and not purely relying on the AI. That can really get you into some hot water.
Mhm. Okay.
Moving down my list comes financial planning and analysis. So we're getting into some areas where there's a bit more risk associated with it. So you have to make sure that you're mitigating that. And it's really, I mean, you need to have accurate predictive insights for budgeting and forecasting. And if you're leaning on your AI for that, you really have to make sure that that information is, again, that you've got good quality information and you've got oversight coming out to make sure that you're making good informed strategic decisions, not just relying on the AI to tell you what to do. Treasury management, involves your liquidity management, your investment strategies, and really your financial risks. This becomes more risky if you're leaning on AI. because you've got immediate financial implications if there's an error in the analysis that the AI is performing. So we start getting into kind of much farther down my list where things I'm a bit more concerned about. Taxation, we start really get into how complex the regulations are and the need for precise data. It's highly sensitive, and any AI inaccuracies here could really lead to major compliance issues, which of course is my number one concern right now, is making sure that we are staying compliant and that we are not using any AI generated data to meet that compliance that is inaccurate, because that is fraught with peril. And then we start getting into more reporting. While this may seem less risky, the aggregation of errors from other processes and the critical role of reporting for compliance and decision making really makes it riskier than you might think. Again, you can mitigate this in various ways. And then last on my list, the thing that causes me the most concern is really around mergers and acquisitions. This has the highest risk due to the strategic importance and complexity and the one-off nature of a lot of these activities. They're not routine like expense processing. You've really got to apply some oversight and knowledge to this. And any AI errors from due diligence or valuation or integration planning could have significant long-term consequences. So making sure that if you're going to use AI for M&A, that you've got a lot of controls in place.
Got it. Got it. So, Cecy, you just mentioned that expense management is at the lowest risk and mergers and acquisition is at the highest. Can you elaborate a little more on the why portion of it?
Sure. So expense management is low risk because it's already probably highly standardized. Expense management processes are typically more routine and involve the processing of expense reports and approvals and reimbursements. The decisions involved are a lot less complex and often follow very specific rules, making them more amenable to automation with AI. And then the impact of the errors in expense management, while they're still important, generally have a limited financial impact compared to errors in other financial processes. Overpayments and underpayments can often be corrected with minimal long-term financial consequences. The data, there's usually a wealth of historical data available on expense claims and their handling, which can be used to train AI models effectively, which dramatically reduces the risk of errors. And then the regulatory and strategic implications of mistakes in expense management are typically less severe than in other areas, making it a lower risk application for AI.
Got it. Okay.
And then on the other hand, mergers and acquisitions are, in many ways the opposite of that. Each M&A activity is unique and involves complex web of financial, legal, operational, and strategic considerations. And AI systems may really struggle to fully comprehend and evaluate those complexities, especially those that require nuanced judgment and understanding of market conditions or regulatory environments. And M&A decisions are highly strategic and have long-term implications for the organizations involved. So any errors or oversights due to AI inaccuracies can lead to significant financial losses, damages to reputation, or missed strategic opportunities entirely. And there's a lot more regulatory scrutiny on M&A, requiring precise compliance with laws and regulations. AI systems may not always be adept at navigating the intricate legal landscape, increasing the risk of non-compliance. And then data sensitivity. M&A involves dealing with highly sensitive information. AI systems require access to this data, raising concerns about data security and the potential for leaks. Additionally, the reliance on AI for due diligence could lead to oversights if the AI fails to identify critical issues within the vast amount of data now analyzed. And it's high stakes. The financial stakes in M&A are enormous, with investments often running into billions. The cost of a mistake, therefore, can be astronomical, not just in terms of immediate financial loss, but also in terms of future growth and profitability.
Got it. Got it. Understood. So, Cecy, we just spoke about, the risk-wise stack ranking of all the finance and accounting functions. Would you like to comment on the return on investment or ROI piece of it, especially in terms of AI-led transformation in the above processes?
Sure. I mean, where there's high risk, there's the potential for high return, right? So if I'm stack ranking ROI, merger M&A is at the top of that list, despite the high risk. The potential ROI of AI in M&A, that was a lot of acronyms, is significant. Let me do that one more time. Despite its high risk, the potential return on investment of AI in mergers and acquisitions is significant. AI can enhance due diligence, market analysis, integration planning, potentially saving millions and creating value through more informed decision-making and strategic alignment. Next on my list in terms of ROI is financial planning and analysis. AI can significantly improve forecasting, accuracy, budget optimization, and strategic planning, directly impacting an organization's financial health and growth trajectory. The ability to make more informed investment decisions can offer substantial returns. Do you want to contribute during this, or do you want me just to keep going?
So Rajiv has told me that it's more of your views and me just asking the question.
Okay.
However, from your response, maybe what you can do is elaborate on the first three. So, for example, in this case, mergers and acquisition, financial planning and analysis, as well as taxation. And then you can just say followed by treasury, procurement, accounts receivable, and then just elaborate on the last one or two.
Okay.
Because I understand why it's looking a little awkward.
It just feels like it's,
Yeah.
which is fine. I can do that if that's what you want, but okay. Do you want me to start over?
I can.
Interrupted?
Yeah, I can just.
Or do you want to just edit that out and I'll just skip to taxation?
To taxation.
Okay. So number 3 on my list is taxation. AI's ability to navigate complex tax regulations and optimize tax strategies can result in significant savings. By identifying tax saving opportunities and ensuring compliance, AI can directly impact the bottom line. In the middle of my list is treasury management, procurement, accounts receivable, and then at the bottom of my list is accounts payable. AI can streamline the invoice processing and prevent fraudulent transactions and optimize payment terms, leading to cost savings and improved operational efficiency. But the operational efficiency is largely there for a lot of things. This is true of expense management as well. While lower in risk, the ROI of AI and expense management is also lower compared to other processes. However, AI can still offer significant benefits in terms of reducing processing times and increased policy compliance and detection of fraudulent claims. And then at the bottom of my list is reporting. Automating reporting processes with AI can improve accuracy and timeliness, reducing the workload on staff. And while important, the direct financial returns might be less tangible than those from other processes, making its ROI potentially comparably lower.
Got it. All right. Thank you so much, Cecy, for giving us an insight into the different ROI angle of things. But similar to risk mitigation, why do you think merger and acquisition has the highest possible return, whereas reporting has the lowest possible return?
So M&A activities are fundamentally strategic, aiming to accelerate growth and enter new markets and acquire new technologies or achieve synergies. AI can significantly enhance the strategic decision-making process by providing deeper insights into market trends, competitor analysis, and potential synergies, leading to more informed strategic decisions. AI can also process vast amount of data at an unprecedented speed, enabling thorough and rapid due diligence. This capability can uncover critical insights that might otherwise be missed, reduce the risk of costly oversights, and identify value creation opportunities, thereby directly impacting the success and financial outcomes of the M&A deal. AI can also play a crucial role in post-merger integration, identifying the most cost-effective ways to combine operations, systems, and cultures. Effective integration is key to realizing the expected value from an M&A deal, and AI-driven insights can significantly impact those outcomes. And by automating and enhancing various aspects of the M&A process, AI can lead to significant cost and time savings, further increasing the ROI of those activities.
Got it.
On the other hand, reporting, while AI can certainly improve the efficiency and accuracy of financial reporting by automating data collection and analysis and report generation, these improvements are more about enhancing operational efficiency rather than driving strategic value or directly impacting revenue growth. AI and reporting mainly addresses compliance and accuracy, ensuring that financial statements and reports meet regulatory standards and are free from errors. While crucial, these improvements do not directly generate revenue or offer competitive advantages. And unlike M&A, which can dramatically alter a company's strategic direction and market position, reporting is a routine process. The benefits of AI in reporting, while important for internal decision-making and regulatory compliance, offer limited direct financial returns compared to the transformative potential of successful M&A activities. And for many organizations, financial reporting processes are already highly efficient, and the incremental gains from implementing AI may be relatively small in terms of cost savings or speed improvements, especially when compared to the capital investments and strategic shifts involved in M&A.
Mhm. Got it. Got it. So just to wrap things up, Cecy, the last question that I'd want to ask you that on a risk versus return basis, what would you recommend the fellow CFOs for, the first set of processes to be picked up for AI adoption?
So it is all about an organization's appetite for risk. Law firms are traditionally very risk-averse organizations. They're aggregations of lawyers, so our risk tolerance is relatively low. If you have a higher appetite for risk and are looking for a high return on that investment, where the risk is still manageable. FP&A, given its direct impact on strategic decision-making and the potential for significant efficiency gains, FP&A is a prime candidate for AI adoption. The risks primarily related to accuracy and data quality can be managed with rigorous validation and oversight. The strategic insights gain can substantially enhance decision-making, offering a high return on investment. Procurement is another high return, manageable risk option. With AI, procurement processes can be optimized to achieve cost savings and efficiency gains without incurring significant risks. AI can help in supplier selection and contract management and spend analysis, directly contributing to the bottom line. And then finally, taxation. While complex, the use of AI in navigating tax regulations and optimizing tax liabilities can yield substantial returns. The risks of compliance errors can be mitigated through careful implementation and ongoing monitoring, making taxation a promising area for AI application. On the other hand, if you are more risk concerned and really want to have a more moderate risk, moderate return, treasury management can offer considerable benefits for AI optimization. You can optimize liquidity and manage your risk and do investment planning. And while the financial stakes are high, the use of AI and predictive analytics for cash flow forecasting and risk assessment can be highly beneficial, providing that there's sufficient oversight and validation. And then AR and AP. These processes can benefit from AI through improved efficiency, accuracy, fraud detection. The risks are relatively manageable, with errors typically being correctable, and the return is primarily in operational efficiency and cash flow improvements.
Got it. Got it. Thank you so much, Cecy, for walking us through the entire risk mitigation framework for AI adoption in finance. It was really great having you, and the discussion was truly insightful, especially for me. So thank you.
Thank you, Emily. I appreciate it.